Good morning and welcome to another edition of the Main Management Weekly Market Note for the week ended August 7th, 2026. As usual, I'm our MD of Research, Alex Varner, alongside
James Maxwell, Director of Research.
Let's get into it. On the performance, a lot more blue than red, both year to date now off the strong week. Tech up 7% alone, materials up 5%, energy down is kind of the Iran on again, off again. Oil prices continue to fluctuate. But year to date, you've got tech now overtaking energy, but both up 30%, call it. So really strong returns on those two, between the biggest and one of the smaller sectors as well in the S&P. On the bottom left there, you can see NASDAQ small caps were up highest on the week. And then year to date, commodities still getting that kind of boost from energy, and then small up 35%, and then small caps up 23, call it. On the recession dashboard, not a ton change this week. Kind of still looking at that inflation being red. We get the CPI and PPI prints this week, so a lot of eyes are on that, especially after this Nonfarm Payrolls report that we had on Friday, where kind of payrolls unexpectedly lost 23,000 jobs, well below expectations for a plus 80K. The prior months were revised lower, so you're running at a considerably lower rate than we were. Part of this is there was government shed like 50,000 jobs, I think, or 53,000 or something like that. So that was a big detriment. And there was a lot of teachers. So it's kind of a weird seasonality where like they got laid off in July and then rehired in August. So we'll see if this corrects again. But I think basically, it kind of opened people's eyes that maybe the labor market isn't quite as strong as the previous prints had led us to believe. Excuse me. The headline unemployment rate ticked down to 4.1%. But again, that's the numerator denominator effect, where it's because a lot of people are leaving the labor force. Labor force itself has shrunk by 2.4 million people over the last 8 months to under 100 and, call it 169 million. A big part of that is the retiring boomers. So you are seeing some big skew as they're retiring, like 10,000 people a day or something, I think. But you can see on the right there, those not in the labor force hit a record high at 106.2 million people. That's up 2.7% year over year, and is up 3.2 million alone in the last 9 months. So you're seeing kind of this out of the labor force move, picking up steam, if anything.
Yeah. I was going to say too that this is kind of one of those bad news is good news type of events that you've seen, kind of over the past few years. You've seen it especially with higher inflation. This is kind of a and you mentioned it here, it gives some sort of breathing room to the Fed, where obviously hikes were kind of on the table or being pushed. If the overall labor market's weaker, maybe we don't need to hike as much, or can even pause. So that's the kind of rationale there. The market kind of shrugged it off so far. Yeah,
you've seen a pull in of the rate hike expectations last week prior to this release were like 1 to 2 hikes for the rest of the year. Now it kind of markedly softened a little bit. So people are now kind of like, all right, maybe it's a more wait and see as we get this, kind of interplay between inflation and the labor market, which is the Fed's 2 mandates. So they've got their work cut out for them, I think. But, kind of long story short, is a little bit weaker than people expected, and the labor market might not be quite as on a solid footing. I think we're in the camp where it's kind of chugging along sideways. I think, kind of variations on, the deviations plus minus 20, 30,000, like it's not that big of a change. One concern is, or another concerning point, I guess, is the wages were wickedly marker than anticipated. They were up just 0.05% month over month, far below expectations for a 0.3% rise. Year over year fell to 3.15%. That's the lowest since May of 2021. That's concerning because wage gains are back below inflation, especially if we get, we'll see what this week's reading comes in at. But again, kind of you want to see wages accelerating, and this is going the other way. So we'll see if this kind of starts to turn around here or not. But I think it's, it's not an ideal, not a great development. On the right, you can see the participation rates. The overall rate, the black line at the bottom there, fell to 61.4%, the lowest since February of 2021. You can see it's being weighed on by the 55 plus cohort. That's that orange line in the middle, which is definitely softening. It's, it's a multi-decade, 40 plus year low. So that's that's a concern as well. Or I guess, sorry, not 40, thanks, 20 plus. But again, it's and you saw the 25 to 50-year-old cohort, that's the kind of prime working age, tick back up to 83.4 from 83.3. So that's good. You want to see that one remain steadily, above that 82, 83% level. Don't forget, like 4 or 5 months ago, we were at the highest level since 2000. So it's not like this thing has really fallen out of bed. You can see that green line there. still chugging along decently, but we'd like to see it, kind of start moving back higher than lower. On the productivity side, we got Q2 was up 1.4% quarter over quarter, solidly above forecast for a 0.6% increase. You can see there's a lot of kind of a lot of move in this, a lot of volatility. On the right, output accelerated to 1.7 quarter over quarter. Is the best since Q3 of 2025, which led to overall productivity up because that outpaced hours worked, which are up just 0.3. This is kind of a longer term trend. We still think we're in this uptrend on the left there. You can see this is the 20-quarter rolling average. We think we're in that uptrend that started back in 2015. But again, you've got these fits and starts where like when everybody was sent home, productivity went up because people were working less and still working fewer hours and still getting their jobs done. You've seen kind of a retracement of that. And the question now is like, do we see this AI build out start to show up in a meaningful way? Because it kind of hasn't yet.
Yeah.
I think people were like, 1.4 is better than 0.6. That's good. Things are kind of chugging along. But as we've mentioned, every time productivity comes up, it's hard to measure. It's like, is it number of emails? What is a unit of productivity? So that's a challenge. On the right there, you can see the unit labor costs year over year. They bounced back from Q1 to 1.4. below forecast for 2.1, and you can see that 4-quarter rolling average remains in a downtrend. It's at a multi-year low, so that's kind of a good sign for inflation as far as the wages and benefits are concerned. The first week of the month is generally heavy with employment data. We got the Challenger Gray job cut announcements, which slowed to 33,429. It's the lowest month in 2026 so far. That's good, but hires are just stuck. Like they're low. They're just 16,000 basically. On a year-to-date basis, we're now at 477,000 cuts versus 108,000 hires. So 4x more cuts than hires. And again, these are all announcements. This isn't necessarily, they don't track if reality comes. They're not like, on average, 85% of these cut announcements come true. So it is very much a headline indicator, but directionally, it kind of tells you that we're still tracking the second year in a row, potentially on, a year where you have cuts outnumber hires. And prior to that, we hadn't had a single year where that was the case. AI has shown up more and more in this report. It's been the biggest reason for job cuts in the last 5 straight months. It's now responsible for 113,000 cuts. So it's basically a quarter of every cut announced has been, or 1 out of every 4 cuts is cited because of AI. And then you've got market conditions at 90,000. So also a large piece. Then businesses closing. It's kind of funny. I feel like market conditions feeds into businesses closing, but it's just a step down the ladder. On the cuts by industry, you can see on the left there, this is net hires. This is hires less cuts. Only like 4 industries have more hires than cuts. Aerospace and defense is up with 6,700 more hires than cuts, while tech is on the other side of things with 132,000 more cuts than hires announced. That's tough. You don't like to see that kind of net hires being so negative. But again, with just the total hires figure, coming in at less than a quarter of cuts, you're going to have almost all the industries more, lopsided in the wrong way. In the center, you can see center on the right, you can see the center is cuts, the right is hires relative to historical averages is cumulative. You go throughout the year. So cuts are basically back in line now. They're trending a little bit higher than history, but right now they're back in line. In July, it's like 1.9% or something. But then you've got hires on the right with a 68% delta. August, we get, in a month, and in September, we'll get the reading then, but you get that seasonal hiring bump in September. So we'll see if that comes back. But last year that was weaker and kind of more broken up across like September and October, and maybe some August as well. So we'll see how that plays through, that seasonality comes in. But again, looks like we're headed towards another year of more cuts than hires.
Yeah, it's funny to me, you see that AI is that leading factor or leading reason why companies are saying they're cutting. And then we look at productivity and you don't see the AI kind of showing up there almost at all, at least so far.
Yeah.
That's kind of counter in my mind, where if you're cutting jobs because people are so
you want productivity to be like, you think that the AI would be boosting productivity and saying, hey, we're more productive with AI, we can cut jobs, we need fewer heads. But
that just kind of shows you how rough this data really is. And it's not exactly squaring the story on both sides.
We also got JOLTS. These are, again, always a month behind. So this is, June JOLTS, but they were basically little changed from the May release. Openings ticked down, hires ticked up, maybe a good indication of quits ticked up as well. Layoffs were basically unchanged. So this one, it is a month delayed. We'll see what the July report comes next in September when this releases. But this shows kind of steady moderation, similar to ADP payrolls, which were up 44K. Yes, they missed solidly missed forecast for 70K figure. Small firms are the driver, large firms added 13K, medium at 8. And they're year over year, they're kind of starting to trend up on a year over year basis. Medium firms are really the only group that's down in the red at minus 0.24%, but that is the least negative in a year. So you kind of see this starting to maybe bottom and start to accelerate a little bit. We'll see again, it's got to continue. But the payrolls and JOLTS data kind of maybe give a little bit of what am I trying to say here? Comfort to the bad non-farm payrolls, where you're like, okay, the other kind of alternative, you've seen this in the unemployment claims are also behaving well. Kind of the tangential, less primary or secondary surveys are showing that the labor market is just kind of plugging along. It's not super strong, but it's also not falling out of bed.
Yeah. It's good to get multiple sources to kind of point you in one direction. You can kind of see that they're pointing in different directions, which to us makes it less concerning if one is bad and the other's good.
Yeah. And again, that payrolls report is also subject to revision. So maybe that gets revised up, or, better next time we get the release in early September. On the trade balance, the trade deficit narrowed a bit to negative 73.3 bill in June, basically in line with expectations. Both imports and exports declined. On the import side, you saw lower purchases of capital goods and consumer goods, while on the exports, you saw weaker shipments of industrial supplies. You can see on the right there, those are the month-over-month figures. Imports are down 1.8, the most since January of 2026, while exports are down for the second month in a row, down, call it 0.91%. Prior to that, they'd posted, multiple consecutive up months. So I think this is just kind of there's noise in every data series. You can see they don't just keep going up and to the right. So there's some volatility in here, which is not unexpected. On the goods side of the equation on the left there, and goods makes up the vast majority of trade. But both imports and exports pulled back, but are both solidly up on a year-over-year basis. Goods imports are up 16.7, the highest since March of 2025, when you got that big tariff pull forward. And then goods exports are up a solid 15.5. And then on the right, services as well. Services are just chugging along. They're kind of less, smaller weight in the trade numbers, but they're hitting new all-time highs on a dollar basis, so indicating solid ongoing demand for services, both inside the U.S. and outside. Imports are up 5.3, services exports are up 5.8, both kind of solid figures. And then finally, continuing with that kind of services piece, is service PMIs. On the left, you have the U.S., S&P, and ISM. Both of those moved higher in July. The S&P figure saw a stronger move, up 54.6, the highest since October of 2025. ISM inched up from 54.1 to 54, from 54 to 54.1, a little bit below forecast. But again, both running at 54, 55, that's solidly in expansion territory. You can see on the right there, employment's the only one kind of sub-index that is below 50 in contraction. New orders, business activity improved. Prices also moved back up to 70.3. So that kind of, says that there's ongoing cost pressures that exist outside of energy prices. So that could be wages, that can be other inputs. But again, you're seeing that price index really stay kind of elevated in the way that you're like, well, they're going to probably keep passing this on to people. In summary, NFP's big miss, but the other two data points that we got, ADP and JOLTS, and kind of job cuts as well, kind of point to just ongoing kind of stability, or, kind of not a huge move away from what we've been seeing the last year or 18 months. Q2 productivity solidly up 1.4. Labor costs also up 1.4. You got the trade deficit that narrowed as both imports and exports declined, and then service PMIs indicate ongoing solid expansion. The big release this week is CPI. Everybody's eyes are going to be on that after the week payrolls figure. So I think forecasts are for like 0.1 month over month, and 0.2 for the core figure month over month. So we'll see what that comes out on Wednesday, PPI on Thursday, then you got retail sales, and that University of Michigan, that preliminary sentiment on Friday. So that's it for this week. Thanks for joining us as always, and we will catch you next time.
Thank you.